A surprise summer election brings the UK economy into sharp focus. Welcome to Market Insight, I'm David Pollard. A snap general election was only announced on Wednesday, but the UK's economy has already emerged as a central issue. CPI figures this week showed inflation is falling quickly, though not as quickly as expected, and retail data out today revealed a heavy slump in April's consumer spending. At a time when the economy is delivering mixed messages, does an election confuse the picture even more? Well, to help answer that and more, I'm joined by independent equity analyst Anna Macdonald. Many thanks for joining us today, Anna. What do you think this week's retail sales data is telling us? It was down, sales were down 2.3% month on month, 2.7% year on year. Is that all down to the weather, or is it a broader consumer sentiment issue? And to what extent are online sales a bright spot there?
Well, I think that the ONS were at pains to say that it was a lot to do with the weather, that sales fell so much. It was a very wet month. And another factor is that Easter came early. Easter was in March and not April. So some of that trade will have been pulled through into March that might otherwise have occurred last year in April. So the poor weather would explain why retail sales for clothing and things like that and outdoor furniture had fallen. There has been a little bit of a bright spot in online, but that's still actually relatively weak. But that could also be because you would maybe order some new summery clothes online and that you weren't just doing that. But the cost of living crisis is still a really live factor for lots of people in the UK. And I think that we analysts hadn't quite figured that kind of quantum of a fall in. So that will be the weather plus ongoing issues with the cost of living crisis. And that's something when you talk about how we feel about the electorate going into July the 4th, that's something that's one of those mixed signals.
So where does that cost of living crisis and the still quite sticky inflation data that we've had leave the Bank of England, especially now that we have the added complication of an election looming in early July?
It's interesting, actually, because most analysts, as you've alluded to, thought that inflation data was actually a little bit stronger than expected on Wednesday at 2.3% and not the 2.1%, which was consensus. And a lot of that driven by quite sticky core inflation, which has come from services, which is to do with wage increases. And that is a sticky form of inflation. So even though the city thought it was quite a high number, it seemed to be one of the things that encouraged Sunak to go for that July date, that he could say that inflation was coming down to near target and that when he became prime minister, inflation was 11%. Now it's at 2.3 and sort of pointing to that as being a very positive factor. But the Bank of England will be looking at this in two ways. It will be thinking that sticky service inflation is still there, but also even though they'll get one more inflation data out in early June, and the decision they make is not until the 20th of June, they don't have the opportunity to explain to the market if they did make a change then what were the driving factors. There are no sort of press conferences after that 20th of June meeting.
Well, amid all the political uncertainty that we now have, the Treasury's planned sale of its 27% shareholding in NatWest, that's its remaining stake, that appears to be in jeopardy. How do you see this panning out, and are Labour likely to follow through on the sale if they win the election?
I think that it would be tricky for them to do any kind of retail or institutional offer right now ahead of the election. They have announced that they're working through internal due process, but the shares were off about 2% yesterday, and on the announcement of the election. And I think that there is likely now to be a delay. I think Labour probably will still want to carry on with selling down that stake. It's worth about 7 billion. The government have owned NatWest shares now for 16 years, which seems like an incredibly long time. I don't think anyone foresaw it would be that long. Whether it will still take the form of a retail offer or an institutional placing, I think is open to question. When you think about other retail offers in the past of companies that have been or of full privatization, that's normally been utilities whether we think of British Gas or British Telecom at the time, those are much more predictable earnings streams with dividend payers and things like that. So whether NatWest falls into that category is a little bit open to debate.
Well, also weighing on market sentiment here and across Europe is, of course, the US rates and inflation outlook, with some fairly big figures in the US now saying that they don't see any rate cuts at all this year. I'm thinking in particular of David Solomon of Goldman Sachs. What's your outlook there?
It's quite a turnaround. If we think about what we were thinking towards the end of last year, several rate cuts slated for this year in all the advanced economies. But we've just been through a series of several Fed Reserve officials talking down the chances of that being able to happen. The latest being Bostich, who talked about how, because it's interesting actually, if we think back to 2021, when we saw that inflation was coming in hotter than expected, much higher than expected, and the banks weren't raising rates, it meant that everyone thought they are going to have to raise rates. So people started locking in debt at lower levels. And that has meant that when the Federal Reserve and others have been increasing rates, it hasn't actually hit consumers or businesses as much as it might normally have done. So monetary policy has been less effective at slowing growth. So I think that means that the Federal Reserve is just going to take more time. It doesn't want to make mistakes on the way down as it did as much on the way up. And the economy does seem to be still relatively robust. So, yes, I think that some of the big banks, whether it's the CEO of Goldman Sachs or others, are talking about potentially no rate cuts at all this year in the US.
Anna, we'll leave it there. Anna Macdonald, independent equity analyst, many thanks for sharing your thoughts today. That is Market Insight. Don't forget you can watch more videos on Reuters.com.